Good afternoon, everyone, and I want to welcome you to our webinar. This is a webinar and not a meeting. So like watching TV at home, you can see and hear us, but we cannot see or hear you. For those who want CPD certs, either email myself or owner after the meeting, and we will email you your cert or copies of the slides. You can submit your questions via the Zoom functionality or emailing Eoin or myself. Two experts are contributing this morning. Eoin Buckley and Andy Ivory-Corr will take their questions at the end of the webinar after Andy's presentation. Our first presenter this morning is my colleague Eoin Buckley of ABM Financial Advisors.
Thank you, Sean. Good afternoon to all. So what I would like to talk to you today about is the generosity of the Irish private pension system and how you can take full advantage of that. Okay, so hopefully there is slides appearing on the screen. So we're looking at the Irish pension system, unlocking the generosity. So when somebody first sat me down and explained the Irish pension system to me, and they brought me through the various reliefs, and when they mentioned employee contributions, AVC contributions got 40% income tax relief. When they told me that employer paid pension contributions were even better, they effectively also receive relief from PRSI and USC. Those employer paid pension contributions also qualify as a deduction against corporation tax. And then that the fund value grows fully tax free. My initial thought to that was that the reliefs, are they too generous? Is the government actually giving away too much money here, right? So this actually is some information from that side of the house, from the government's view on what they're spending here. So this is from a wider report, right? Anyone interested in all the detail? It's from the Tax Expenditures in Ireland report, October 2024. So somebody can Google that if they want the full detail. You're just going to get one graph from me. And this shows the top 20 tax breaks in Ireland. And pensions figure very substantially on this. So 1.154 billion for pension contributions. That would reflect the income tax relief I mentioned, up to 40%. The employer contributions, 956 million, another huge number. And there's even a third number down there, employer contributions for superannuation schemes, 323 million. So when you put the three of those together, you're getting 2.4 billion. And you can really see why they had to split that into three sections, because if they had just included it as pensions 2.4 billion, it would have been off the chart, right? So that is incredibly generous. So let's have a look at how you can benefit from that. So there are limits. Often people ask me, why do they have all these rules and all these limits? Well, I think from the previous slide, you can see the quantum of money that they're giving away already. So these limits are in place to prevent even more money going out there, right? And just when I talk about that 2.4 billion number, there's another massive pension tax break that isn't even included in that. And that's that your pension fund grows tax-free. So that would be in addition to that 2.4 billion. So there really is a lot of money being given away here. So we're going to look at limits on employee contributions, employer contributions, and on the amount that you're allowed having the fund itself, which would be the standard fund threshold. So just quickly on employee contributions, my examples, as I tend to age, my examples tend to age. So I'm just going to pick somebody age 50. Let's say they were on 100,000. They can contribute 30% as a pension contribution. So they contribute 30,000 and receive income tax relief of 40% on that, right? Just to look at that 40% relief in another way, right? When you put in a €100 contribution, your net pay only comes down by 60. Right, so because that 40% is the tax relief, so that 40 over 60 is a top up, and that's 67% top up. So when you compare that to auto enrollment, which is getting a lot of focus at the moment, auto enrollment only offers a 33% top up. So one message, possibly unfortunately for those organising auto enrollment, is higher rate taxpayers should actually avoid auto-enrollment. So moving on to employer contributions, you'll see the quantum of money that an employer can pay into a pension scheme is incredibly generous. So if we go back to our 50-year-old example and they're on 100,000 salary, the employer could actually fund 200%. So in other words, they could fund 200,000 into their pension fund in certain circumstances. So that is an incredible amount of money. Now, that's going to happen in a limited amount of situations, typically where the employee is effectively the employer. By that I mean that they're most likely going to be a director and a shareholder of their own company if they're going to be looking at contributions to get near those limits, right? And as I mentioned, you're also saving PRSI and USC, so that's a €52 saving over 48, which is what you're forgone in your net pay. So that would be 108% top up. So very, very generous stuff. The standard fund threshold, this is also very generous. This is the amount of money that you're permitted to have in your pension fund. Right now, that's at 2 million. And it's actually set to increase by 200,000 per annum for the next couple of years. And in 2029, that would make it a total of 2.8 million, right? So I mentioned that you get tax-free investment growth. So that would lead us to the question, well, where do you invest? So in broad terms, now I know Andy will have a lot of detail on this, so I'm just kind of setting this up just for the basis of how it relates to a pension. Your money can be invested in broadly 5 main places, the 5 asset classes. So the first one would be cash, the likes of deposit accounts. Second one would be bonds, when we hear about government bonds, be it German government bonds or Irish government bonds. The third place is equities. So you'd be hearing a lot about the S&P 500, American market, and of course the NASDAQ is very volatile at the moment. Fourth place would be property. Fifth place would be alternatives, the likes of oil. Gold has had quite a strong run as well in recent times. So they're in broad terms the 5 places you can invest. If you're at the lower risk end of the scale here, you would have quite a high proportion in cash and bonds, whereas as you're moving up the risk scale, the cash and bonds percentage is decreasing, the amount of equities is increasing. So just to have a look at somebody with a maturity value of 800,000, so we can just be thinking of a stereotypical 65-year-old. Their pension fund is worth 800,000. So how did they get to that number? What are kind of the building blocks that got them there, right? So up in the top right is that investment growth that's tax-free, all right? So in broad terms, you'd normally expect this to equal 3 equal amounts. So a third of the 800,000, about 267,000, came from that investment growth that was tax-free. Over on the top left side, they would have received immediate tax relief on their contributions. So that would have been tax relief at the point of entry. That when we looked at employee contributions at 40%, employer contributions effectively 52%. So that amount in the middle, that net contribution cost, that's the amount foregone in net pay. So that's really the amount it's cost them out of their pocket. About 267,000, about 1/3 to have a maturity value of 800,000. Now, that would be using an example of somebody contributing for possibly 20 years, because you do need a bit of time for that investment growth to take hold. So then just to look at their retirement options. So a quarter of that fund, quarter of the 800,000, 200,000, that is the tax-free lump sum. And then the balance of that amount, the 600,000, that is going to be taxable income. So we need to think of a few ways to minimize the amount of tax that is paid on that taxable income as it happens. So you would be obliged to draw down 4% of that ARF number. So 4% of the 600,000 is 24,000. You will be obliged to draw that down from age 61 onwards. But what you will find is that that is very much below your standard rate band of tax. So what we want to do here is create a situation where we're not paying high rate tax when you're drawing down your taxable pot of pension money. So looking at the standard rate band, so that just means the amount of money that you can have without paying income tax at 40%. So this is the amount that you pay income tax at 20%. So for single people, it's 44,000. So for a couple, you just multiply that by 2. So a couple can have 88,000 euro coming into the house and just be paying tax at 20% income tax only. For married and civil partners, it's still 88,000 is the total number, but you get a bit of flexibility there. You can slice and dice that number. If you have a higher earning spouse, they can earn up to 53,000 at the low rate. Lower earning spouse can be at 35,000, and you can hit 88,000. So when we looked at that 24,000 number coming from the ARF, and you even add the state pension of 15,000, you're up to 39,000. You still have a bit of room before you're hitting high rate tax. Now that might be taken up by rental income or dividend income. So just to have a look at the absolute fund maximum right now, look, there's not a huge proportion of people are hitting 2 million, but I actually have one on my desk right now, and I was kind of just looking at it with quite interest, knowing that this webinar was happening. So how that 2 million fund and the person is age 60, right? So would you believe that the top right number, the ongoing tax-free growth, accounted for 1 million in his example of the 2 million? So the investment and the tax-free growth on it really, and the compound interest of that, really did the heavy lifting on that. So that means that the other 1 million was contributed, but on the top left corner, when we look at the tax relief of 52%, because this was mainly employer contributions, the tax relief on that was 500,000. So that middle box, that net contribution cost, again, that was net pay foregone over the years, was 500,000. So like that is an incredible way to turn 500,000 into 2 million. So in this case that's on my desk, the guy, he was age 40 and he had no pension. So he managed to achieve this in 20 years between age 40 and age 60. Now, contribution wise, he was getting 50,000 a year in there for 20 years. But like I say, a lot of that was, half of that was relieved through tax relief and contributions. So again, the net cost to him there was 25,000 per annum for the 20 years. So when we look at then retiring that, so a quarter of that fund is 500,000. So the first 200,000 tax free. The next 300,000 there is taxed at 20% only. So there would be a tax bill there of 60,000. So in this case, if you retire this immediately, you would see a lump sum of about 440,000 going into your current account within a week or two of submitting your retirement papers. The other 1.5 million that will be in an ARF, or in recent years could also be in a vested PRSA, forced to draw down 4% of that, that is 60,000 euro. Now, again, in this case that I'm looking at, he actually doesn't want 60,000 euro because he has rental income of about 40,000. So he actually only wants about 20,000. So what we can do in that situation is we can utilize the flexibility of the PRSA. So what we're doing here is, as a pre-retirement transaction, we are moving the money out of the master trust type based pension scheme that he's in and moving it into 5 different PRSA policy numbers. Now, he could have as many PRSAs as you want, but we just thought it was keeping it reasonably straightforward to have 5. So you can have a PRSA policy of 400,000 each, and then you can just retire these one at a time. So it gives you the ability to control the amount and timing of the retirement cash flows you're getting in retirement. So what we will look at doing here is we will retire the first PRSA, so the 400,000. He will get 100,000 of that tax free. The other 300,000, he will be forced to draw down 4% of that, which is 12,000. He actually wanted 20, so we'll dip into that PRSA and take out another 8,000 to hit that 20 number, to hit his standard rate band. Now, just to mention, all this plotting and planning ends at age 75, when all uncrystallized PRSAs must be vested at that point. But in this case, the guy I'm working with is 60, so he's 15 years of plotting and planning to do exactly what he wants. Now, anyone who knows, when they meet me, they know at some point I bring up the not so cheery subject of death, right? And what happens to my monies when I die, right? So here we're just looking at this in a post-retirement type product setting. So we're looking at the ARF or the vested PRSA. So again, going back to that stereotypical 65-year-old. He's drawn down his tax-free lump sums. The balance is a taxable ARF. So what happens when he dies, right? How does that work, right? So in normal cases, the ARF will go to an ARF in the name of the surviving spouse. Now, that doesn't create any new taxes at that point. There's no capital acquisitions taxes. There's a spousal exemption. So the spouse just takes over that ARF, or the phrase they use in the textbooks is the spouse steps into the shoes of the ARF holder. So, and then they're drawing money down as taxable income, just as the first spouse was. So then when the second spouse dies, they will most likely be looking to pass this on to children. Now, small bit of subtlety on how this is treated from a tax point of view. If the child is over age 21, there's no capital acquisitions tax, but there is an income tax at a rate of 30%. If the child is under age 21, there's no income tax here, but it is a taxable inheritance. So you are looking at capital acquisitions tax, and you're into threshold amounts that 400,000 can be received tax-free, and the balance at 33%. So there is a small little difference there. So the odd time, I mean, very much the norm is the ARF or the vested PRSA passes from one spouse to another and then to children. On a rare occasion, somebody looks at this, particularly maybe in a high net worth estate, and they might kind of be looking at that kind of going, well, when spouse number one dies, spouse number two takes it over, but they're probably going to be paying 40% income tax if we're dealing with high net worth people, and a bit of USC. So would it be better to transfer it to a child and get it into their hands at 30%? Because 30% is the lower number here, right? But look, tread carefully with that one, just worth mentioning it. So anyone who's done an ARF with myself, you will get a letter from me, and on that letter, I will give you two jobs at the end of the letter. One is that you need to contact Revenue and make sure that your tax credits and your standard rate cutoff point are communicated to the life assurance company, so that they know. The life assurance company, it's like they become your employer to the extent that they will send you a payslip and they will tax your money. So you need to have the right tax credits and standard rate cutoff point so that you're taxed correctly, right? The second job I give to people is I say, make an appointment, go into your solicitor. You probably have a will already, but now that you have an ARF or a vested PRSA, this would be a good time to go in, amend your will, specifically include this ARF in there so that it's very clear who is to get it on your passing. And also, as you're in with the solicitor, I'd mention, just bring up the subject of an enduring power of attorney. So just to mention, right, if somebody said, is there any way that there's no tax to be paid on the passing of an ARF to a child or whatever, I'm just going to mention there is a Section 72 whole of life assurance policy that could be set up by parents. So if this was going to happen, what you would normally see is both parents would set this up as a joint life second death. So that would mean nothing happens when spouse number one dies. When spouse number two dies, this amount pays out, and that amount can be used to pay the child's, be it income tax bill over age 21 or inheritance tax bill, without this whole of life payout being a taxable inheritance itself. Now, very good in theory. In practice, what you find is that the parent is obviously a bit older when they're going to go about this, so it can be a bit difficult to get that life cover. They're going to have medical ailments. It might be priced a bit more expensively, or in some cases it might be refused. But for now, it's just good to mention that it does exist. Now, a lot of items not covered today. I'm thinking if you were hearing this information up till now for the first time, it may seem tricky and complicated in part. It could have been a lot more complicated. There was a lot of items that weren't mentioned today. I just want to make you aware of them. And also, as I just quickly mentioned these, if there's any of these that you're interested in hearing more about, let us know. We could use that as a subject for a future webinar. So a lot of things that come across my desk. So people funding a pension, should they do it via master trust or PRSA? The answer on this changes depending on the year you ask me the question. If we went back 3 years ago, master trust would have been the answer. 2 years ago, due to changes in the Finance Act, they very much improved the PRSA to the extent that last year, if you'd asked me that question, I would have said a PRSA is a way to go. Then in the most recent Finance Act, they reined back some of the benefits of the PRSA. Now the answer is it depends. Now you might say it depends on what. It depends on what you're trying to achieve. Are you focused on trying to get as much money in as employer contributions as possible? That's going to be master trust. Are you focused on a debt and service payout that is the most efficient? That's going to be PRSA. So they're one that's a tricky subject and changes from year to year. Moving jobs. So maybe somebody gets fed up with their employer, they want to move on, they find a new job, they move from company A to company B. What should they do with that pension fund in company A? Right now, I'm going to say straight away, it doesn't tend to be a good idea to move it over to company B, and we can go through that in more detail. So if moving jobs is about you getting fed up with your employer, redundancy or termination is your employer getting fed up with you. Okay, so this, if you go back, I suppose, a number of years ago, redundancy was always seen as bad news. I would actually see that quite differently now. I would see redundancy and termination payments, for some people, it can be viewed as very good news. It gives them an opportunity to get tax-free cash. Statutory redundancy will be tax-free. Termination payment, there will be an element of that will be tax-free. And within the various options and calculations, there's something called a standard capital superannuation benefit. And you can often get more money in that route by waiving a right to a pension tax-free lump sum. Now, I wouldn't be advising anyone to waive their rights to a pension tax-free lump sum, but it's something that we can go into in detail and look at your options. Early retirement. Somebody can retire early. You can get at your pensions money from age 50. We could have a look at what that looks like. Choices at retirement. We just assumed everybody was taking their tax-free lump sum and going into ARF or vested PRSA. We did not mention today about the annuity. So that is also something that definitely needs to be considered at the point of retirement. Lump sums at retirement. We looked at 25% of the fund value. We ignored the fact that there is another calculation possible. We're up to 1.5 times your gross salary could be the way that you go about getting that lump sum. AVCs could be used to go to ARF, but beware, the balance would be forced into an annuity. But again, it is something to look at. We didn't look at defined benefit private pension schemes. Often what you'll find is, sometimes a scheme gets into financial trouble and the member is kicked out, and there's a figure that a transfer value that's given to him in a defined contribution arrangement. Sometimes the scheme is in good shape, but they'll still offer the person retiring at age 55 a big ball of money to come out of the defined benefit scheme and then go into their defined contribution arrangement. Right now, tread with caution, but it's something out there that happens. So there will be a few people even listening in today who are in that situation or have had that situation. So that's another topic that could be discussed someday. We didn't mention defined benefit public sector schemes. We didn't really mention the state old age pension. Plenty of change going on there. You don't have to take that state pension at age 66. You can defer that to age 70 for a higher figure. Now, another reason why you might consider deferring that, the state pension approach has moved to a new calculation method, or is in the process of doing so, the total contributions approach, where you need 40 years of PRSI contributions to get a state pension. So maybe delaying your state pension from 66 to 70 would allow you a couple of years to accumulate some more PRSI years. Pension adjustment orders. We didn't talk about people getting divorced and how that impacts on pensions. We spoke about death post-retirement, but we didn't speak about death before retirement. Now, we did that in a previous webinar, so feel free to look up our website there, April 2024, when we went into some detail on that. So my last slide, the items that we did cover today. Okay, so we spoke about your pension fund, how to save it, the tax reliefs available on your employer contributions, make the absolute utmost use of those, try and hit the maximum you're allowed to put in. How to grow it. We looked at, just talked in broad terms about the asset classes that you'll be investing in and how they will benefit from tax-free growth. We spoke about how to spend it, using your standard rate band of tax wisely, and considering, for larger amounts, multiple PRSA policies for flexibility and drawing down those cash flows. And we also spoke about how to pass it on, capital preservation for the next generation and what happens there. So with that, I will take questions at the end if there are any. And for now, I'll hand you back to Sean.
Thank you, Eoin, for your insights and your expertise. So our second and final presenter this morning is Head of Investment Sales at New Ireland Assurance, Andy Ivory-Corr.
Thanks, Sean. I hope everyone can hear me clearly, and good afternoon to everybody, and thanks for the opportunity to speak with you this afternoon. A lot of information, I think, taken in from Eoin there in relation to pension planning, and what I'm going to cover off for the next 20-25 minutes is just a little bit around markets and the behavioural aspect of investing, and in particularly in relation to pension investing. I've entitled the presentation "Investing at a Price of Emotional Comfort," and this comes from the area of behavioral economics, which is we typically as investors pay a high price for emotional comfort. I think it's quite timely today, just given that we have had quite a roller coaster ride in markets since the middle of February. And that short-term roller coaster ride can lead us as investors into making short-term decisions which really affect our long-term success in investment. So I wanted to try and look at some of where we are with markets at this particular point in time. First of all, let's just start off by saying it's been a number of very good years for us as investors, but the last 12 months has also been very good for us across pretty much all asset classes, or most asset classes. And there are some exceptions, but they're quite specific. But we can see equities have done well. Emerging markets have done well, Euro corporate bonds, and even cash has delivered for us in the last 12 months. And I think the interesting thing when we look at a graph like this might be that if any of us have money in a pension fund or invested at this point in time, we could look at this graph and say, well, that isn't how it feels to me at the moment, because we're hearing about tariffs out of the United States. We're hearing about, equity markets having a difficult period. And I think the difference between the absolute return on some of these assets, which is what you're seeing here, equities returned almost 12% over 12 months, versus the actual journey to get there, can look very, very different. So this graph is actually showing you the actual day-to-day movement of all of those assets. The very same level of information from the previous graph is also on this graph, except now I'm showing you the day-to-day movements. And we can see equities have been the dominant driver of return, and that's the green line on the graph, the top green line on this graphic, followed closely by emerging markets, both considered risky assets, both typically volatile assets. But what we can clearly see here is, even though the absolute return from both of them over 12 months has been quite strong, at sometimes in that 12-month period, the journey to get there has felt quite uncomfortable. And that really, I think, is the theme running through a lot of the messages that I'd like to give over these 20 minutes, is that volatility is just part of investing. And I think in order for us to achieve our long-term goals and to try to generate the sort of returns that a lot of the time we need to generate to achieve those goals, we kind of have to live with that day-to-day volatility and not allow ourselves to get spooked by what might be happening in the here and now. We're all inclined to suffer from what's called recency bias. And recency bias is that we are inclined to react based upon what we're hearing in the here and now. So what's in the news today or tomorrow or yesterday can be what leads us to make short-term decisions, as I've said, which can really impact our lives maybe in 10 or 15 or 20 years time. So I think the key message is to try to avoid reaction to short-term volatility in markets. But we have seen some trends coming through in the last little while. I'm not suggesting any of us should react in any way to these trends, but it is good to be aware that there are some changes have come through in the last little while. And we had become used to the dominant return of equity markets coming from the United States. Many of us may or may not be familiar with the fact that the US makes up about 70% of the world index today. So if you're just an investor who's diversified across the world index, about 70% of your money is in the US. Year to date, what we've seen is a bit of a change for the books. Europe, up to the 25th of March, which is a couple of days ago, is showing a year-to-date return of 8.1% positive, while the US is showing minus 6.7% negative. That's quite a big swing. And that has made a big change for the books for us as investors when we've become so used to the US being the dominant positive driver of our returns. The one I will ask you to take note of is where the green arrow is pointing to the bottom line there, which is the Magnificent Seven. Now, I hate using such terminology, but the Magnificent Seven has become quite a common phrase that's been used in investment markets over the last couple of years. And it is the domination or the dominant impact that a very small number of companies have had, not just within the United States, but actually within the overall world index. To put this in context for everyone on the call this morning or this afternoon, for the year 2024, these 7 stocks accounted for about 42% of the overall return from equities in that year 2024. So we've seen this concentrated dominance of quite a small number of stocks. We're probably familiar with them, but just to show you as an example, Apple now makes up 6.8% of the S&P 500, which is the top 500 companies in the US. The green arrow I've put over Tesla because Tesla has been one of the Magnificent Seven stocks, but given the fall in its share price in the last number of weeks, what we've seen is the great Warren Buffett's company, which is Berkshire Hathaway, has now taken the place of Tesla. But effectively, we are still seeing this dominance from these top companies. And what you've seen on the previous slide is they have been the ones that have been impacted most at about minus 15% year to date. And this is due to the fact of the uncertainty of tariffs and of interest rates and the impact interest rate uncertainty can have on what we call growth stocks. And these are stocks that are typically trading a little bit more expensive than the market itself. The reason they're trading that way is because we believe that they're going to grow faster than the market itself in the future. And we are typically willing to pay a premium for that future growth. If that future growth becomes questioned, then obviously that premium that we're willing to pay becomes smaller. And the way that typically becomes smaller is these shares fall back in value. But I do think it's really important for us to just keep the recent market weakness, keep a sense of perspective on it. Effectively, the drops we've seen in equity markets year to date have really just brought us back to where we were in around the 7th of November. So when you look at those drops through the lens of that longer term nature, which is I'm showing you a 5-year return here, it really should show us that making any sort of knee-jerk reactions when we get a weakness in markets like we've just seen is something we should think very carefully about and instead think more about what our long-term objectives are, what the tax reliefs are we can get for our pension, and what sort of a pot we can expect to achieve over whatever number of years we have to retirement. And behaviorally, and I do a lot of lecturing on behavioral finance and behavioral economics, one of the things we do know behaviorally is that it can be very difficult for us to keep that long-term perspective. And I think if you were to look at this graphic, the top graph is something like we've been seeing in the last couple of weeks. It makes us nervous what we've seen over a week or 2 or even 4 weeks. But when you put that in the context of that longer term market, and as pension investors or long-term investors, none of us should typically be invested in market-related investments for less than 5 years. We would say 7 to 10 years would typically be the time frame. And risk typically dissipates with time. I'm not saying it's eliminated, but it dissipates with time. And I hope that this graphic is just another example of how the short-term movement, when put in the context of a long-term investment market, really does become much less relevant. What we do see out of the current weakness is that the actual valuations applied to equities have now come back. This is a fussy-looking slide, but in very simple terms, not knowing everyone on this afternoon's call, I don't know what level of knowledge people may have, but typically every company, every stock that we can buy today trades on a multiple of its earnings. Therefore, every stock market trades on a multiple of its earnings. Sometimes that multiple of earnings can be quite high, as the graph here is showing back in 2000 on the left side of the graphic, which was the technology bubble. Then we saw similarly again in 2020 prior to COVID. But essentially, the forward PE, which is the price to earnings that we are typically willing to pay to buy a basket of global stocks, in February was at 22 times earnings. Today, that's at about 18 times earnings. What that means is that this current market weakness has made the price at which we can buy the global stock market quite a lot cheaper. The long-term average is about 16 and a half, so we're still a little bit expensive relative to long-term average. But what I would say is this does pose an opportunity, but the threat that is also there in the background that we just need to be mindful of is, in order for that PE ratio to make good sense, we do need the underlying expected earnings to come through. So we are seeing some nervousness about the potential for recession in the United States. That could obviously impact the underlying earnings of some of those companies. And so I would say, as investors, if you were just wondering about short-term markets, the one thing to watch out for is, do we see earnings coming through as expected in the next number of months? It could well be the next leg down for equities in the short term if we got any short-term surprises. My message, however, is that what time shows us is that being diversified is the key to long-term success. Eoin, I think, spoke eloquently about that earlier on in his presentation. He spoke about the range of different assets that we can invest in. Our key mantra would be to be diversified across a range of assets within your pension fund, within your investment fund. And I'm showing you here back as far as 2007. Again, this looks like a very fussy graph, but there's a very simple message from it. Ranked from top to bottom, under each year, shows you the asset that had the best performance at the top and the asset that had the worst performance at the bottom under each particular year. The blue line is tracking the performance of global bonds, typically government bonds. The orange line is tracking the performance of global equities. And what we can clearly see over those years is the random path that both of these assets take over time. And what it leads me to always preach is to say, how can we possibly try to foresee which of those assets is going to be the best performer every year? Very, very difficult. The easiest way in which to try to deal with that is to try to ensure that we remain as diversified as we can to suit our time frame for the investment, but also to suit our objective. We are going to have plenty of things for markets to be nervous about, folks, as we go through 2025 into 2026. I could spend all of this webinar speaking to you about the 4 points alone that I've put on this slide. Where do we go with tariffs? We don't quite know. One day they're on, one day they're off. Then they're on, but they're limited. Then they're on, but they're excluding motor vehicles. You can see the trend that's coming through, which is that the market has been reacting quite negatively to the threat of tariffs. And then as that threat becomes lifted, the markets rally again. I don't think we've seen the last of that. So, we've probably all heard of bull and bear markets. I think this market is probably going to be closer to a kangaroo market, which is that we're going to be finding that it's bouncing around the bottom or bouncing up and down on a day-to-day basis, week-to-week basis, as the tariffs find their levels in the next number of weeks. Inflation still remains an unknown. Is the inflation genie back in the bottle? If it's not, does that mean that interest rates won't go down, as the markets now expect? We still do expect European interest rates to go down by at least another 0.5%. Please don't take anything from that, because those sort of forecasts to me are relatively futile, because things that happen in a very short period of time can change that. However, the general market consensus is for Eurozone interest rates to go down further. The market consensus is for US rates to go down further. And so I think the market for the next while is going to be driven by what happens with interest rates, what happens with inflation, and a lot of that will be driven by what happens in the US with their tariffs campaign. And all of that, I think, leads to the bottom right here, which is, do we see a squeeze on company earnings? Do we see a recession in the US? And if so, what impact might that have on company earnings, and what impact that might have on global equities? If you're a very short-term investor, those things may matter. If you're a long-term investor, in the main, they don't. Because in the main, what happens in markets, when you look back in 10 years' time, what happened in the market in 2025 is probably going to be reasonably irrelevant. And I think if we just take the last 20 years, and I can show anyone on this call this same sort of graphic going back over 100 years, every environment we're in always throws up plenty of reasons for us to be nervous. There is always some pending crisis, but typically, if you believe that economically the world is going to continue growing, if you're buying good quality assets, be it property that throws off a rent, be it equities that throw off a dividend, and we see these underlying companies becoming wealthier over time, we should expect that over time the market trajectory is upward, but certainly in the short term it can be downward. And that's why we need to, as best we can, position our portfolios for the period of time in which we wish to invest. And if that period of time is greater than 7 years, realistically then try to ignore as best we can that short-term noise of the market. And that is easier said than done. And I said about the high price that is, as investors, we pay for emotional liquidity. Where that comes from is a lot of the time when we knee-jerk react and take money out of markets, a lot of the time it's because we say, well, we need the money. Actually, what's been proven is that a lot of the time we don't need the money. We don't actually run out of financial liquidity. We run out of emotional liquidity. And it's that emotion that leads us to act. And that is a high price to pay for investors, particularly if we're in a situation where we've bought high and then we typically sell low. So the great Warren Buffett, the greatest investor that's ever lived, he says what's required for successful investing is a sound intellectual framework for making decisions. And I think when you're dealing with Eoin and Sean and you can have that advice to help you to do that, then you need to have the ability to try to keep your emotions from corroding that framework. Now, we have a very fussy looking slide here. And I really just want to highlight to you a very simple message from this slide. And I think you will have these slides sent out to you so you can look at this in more detail. We've had a 10% drawdown in markets this year so far. So in other words, the US market has been down by just over 10%. And that can lead us to get a little bit panicked. What I'm showing you here is back as far as 1980. And I'm showing you each year, this is the S&P 500, so the top 500 companies in America. The red number underneath the line is showing you how far the market fell at some point in that year. And the blue bar, the number at the top of the blue bar or the bottom of the blue bar, is telling you where that year ended up. So what we can see is a 10% intra-year drawdown is far more common than we might think. And I'll just give you an example of, if we take the example of 2020, fifth one from the right-hand side there, you can see at one point we were down 34%, but you can see the blue bar shows 18%. That means at some point we were down 34, but we actually ended up positively 18. But if you were to take time and look across this graphic here, the number of years in which we had greater than a 10% drawdown intra-year is quite significant and probably far more than many of us think. We can also see that the number of actual negative years is relatively small when we take into consideration the context of being a long-term investor. Of course, we can't speak for the future, but I think sometimes the past can help us to get our head around being able to deal with that short-term market volatility. There is a phenomenon in investing called the behavior gap. And this is really, I think, one of my key messages, which is we as retail investors during a period of market volatility, we can be inclined to decide to move to cash or decide to move to safer investments. I can't say that's wrong for anybody. It has to be at an individual level based upon individual circumstances. But I think suffice to say the important point here is that we've seen through history the difference between what an investor receives in an investment versus what the actual investment itself made over time can be quite big. It can be a number of percent depending on the asset involved. And that number of percent is what we call the behavior gap. We would always say to try and mind that you don't end up getting caught up in that behavior gap and ending up costing yourself money. So we think about the long-term objectives of investing. If it's pension investing, it's typically to get yourself to a particular level of money. If it's just monies that you've invested that were sitting in a bank account and you've invested for the longer term, I would say one of your primary objectives for all of us as investors, including our pensions money, by the way, should be to try to keep our returns ahead of inflation. I think we've all seen what Irish inflation has been over time. Typically, a lot of your bank deposit accounts don't keep you ahead of inflation over the longer term. That's not to say a deposit account isn't the right thing, because for short-term liquidity, of course it is. But this is something you may or may not have seen before. It's called a rule of 72. And it's a very simple numeric. It's if you take any interest rate between 1 and 10% and divide the number 72 by that number, it will tell you how many years it's going to take for you to double your money. So for example, if we take 3%, you can see 3% on the graphic beside, in front of you. It's going to take 24 years if you earn a return of 3% for you to double your money. And that's very simply, if we divide 3 into 72, it's 24. If we take that to 6%, well, divide 6 by 72, it's 12. It's going to take you 12 years. So you can see very quickly the impact, every incremental 1% additional return that you can make, the impact it has on the actual future value of your investments. And therefore, the big difference between making 2% on your money versus making 5% on your money, particularly as a pension investor, can't be underestimated. And Eoin spoke again about the importance of compounding. And I think when we speak of compound interest, Einstein referred to compound interest as the 8th wonder of the world. Simple metric here to demonstrate. I know it looks like there's lots of numbers here, but take two investors, investor A and investor B. Investor A began investing at age 25 until age 32, is to the left side of this graphic, and put 2,000 euros away each year for that 7 years. Never put in any more money, or for 8 years, I should say, never put any more money in, and had compound annual growth of 10% per annum. Investor B began investing the year after A stopped, so at age 33, and put in 2,000 a year every year to his or her 65th birthday. So has kept investing right up for 32 years. At the end of the period, investor A put in 16,000, the red ring to the left side. Investor B put in 66,000, the red ring to the right side. But you can see investor A has a pot worth 584,000, while B has a pot worth 488,000. Why is that? Well, that is the power of compounding. And the reason for that is because investor A has been making more money by the age 33 than investor B is putting in each year. And that just demonstrates to us the power of compounding. The earlier you can start investing into your pension, the better. And for every 5 years that you put off putting money into a pension, it can have a significant impact to the long-term pot that you end up with at retirement. These are real numbers, folks, that I'm showing you here. Two investors aged 25 and 35, putting 5,000 a year with 5% growth per annum. So they're very realistic numbers. And you can see at age 65, assuming linearity of return, by the way, so I know that might not be the real world that we all live in, 639,000 for the person who started at age 25, 354,000 for the person who started at age 35. Quite a big difference. For every 5 years you put off, it makes a significant impact on the long-term value of your pension pot. To the right side, it's the importance of investing in real assets. So don't underestimate the compounding of rent from property, but much more importantly, the coupon from your bonds, and most importantly, the dividends from your equities. A lot of the time we think about investing in companies for the capital gain that we can get from those companies over time. That is fantastic. But remember, why do you invest in a company in the first place? You invest in it for the growth and the profits and earnings of that company. How do you share in that? You share in it through dividend. And again, look at the difference between the investor who had the inclusion of dividends versus the exclusion of dividends. I think the long-term numbers are about 42% of your long-term return from equities is attributable to dividend. And sometimes when you invest in investment products or investment options that exclude you from dividends, it really can make a big difference. And I think it's something that we need to be very, very aware of. High yielding equities can make a big impact to the value of your pension over time. And my last couple of messages before I finish up really is stepping out of the market can have a big impact on returns. Again, I can't in any way advise anyone individually on this call because what I want to give you is generic messaging, but just an interesting 20-year period here to show you 2002 through to 2022. I'm showing you the global MSCI World Index, so it's the global stock market. And if you just missed the best 40 days, so think of the top 40 days out of that 20-year period, if you'd invested 10,000 euro in August of 2002 and missed the best 40 days of the market over that 20-year period, your growth would have been 0.08%. And you can see if you stayed fully invested, your growth would have been 8.41%. So it's one extreme to the other. But just look at missing 40, 30, 20, or 10 days. Even the impact of missing the best 10 days goes from 8.41 down to 5.16. Now, I know sometimes someone might say to me, well, Andy, yes, you're talking about missing the best days, but what if we can miss the worst days? Well, the ideal scenario would be if you could miss the worst days and just get the best days. But what we typically find through history is that the best days in markets typically come after the worst days. And unless you have the ability to time that on an ongoing basis, the best results that most investors will find going back through a long number of years of history is that staying invested over the period to achieve your long-term objectives is typically the optimal solution. And really, I would say very simplistic messaging here. I know most people are probably very familiar with this, but when you sit with Sean or you sit with Eoin and you're thinking about either your pension or an investment that you've made or that you want to consider making, I would say 3 key questions to always have in front of you on the desk. What's my objective? What's my objective for this new investment? Or what is my objective for my existing investment? And has that in any way changed if it's an existing investment? What's my time frame? The longer I have, typically, the less impact short-term market volatility is going to have. But if your time frame is short, market volatility can make an impact. So how long do you intend to invest for? And has your time frame changed? And then under risk, how much risk are you both willing and able to take? You can go through a risk profile questionnaire. It will typically tell you how you think about risk, but then you have to have that broader conversation with Eoin or with Sean that says, well, how much risk are you capable of taking? And that could be based upon your proximity to retirement or your proximity to needing the money. And that, to me, is the holistic conversation that should then determine what your exposure is to each of the main assets that Eoin spoke about in his presentation. Where can I invest? Shares, property, bonds, cash, a range of alternatives, having some risk management at play in the background in the event of markets having a downturn, maybe having different fund managers. There's so many different layers of diversification. The one drawback I see in a market like we've just come through is that we can start looking at certain areas where we believe we're going to make the best return, lose sight of the importance of diversification because we can be inclined to chase the asset class that has done best over the last couple of years. I've seen that with US equities, with technology, with so many different assets. But I would say as a long-term investor, being diversified typically is the key to long-term success. And always remember, when it comes to investing in any asset class, try to avoid looking backwards. As they say, you don't drive forward by looking into the rearview mirror. What really matters is, what do I believe can generate a return for me into the future? And that future might look very different to the past. So don't determine what assets you have in your portfolio by looking backwards. I would always say try to sit with your advisor and ask ourselves, what do we believe can make money for us as we look forwards? And that can be just about diversifying across a range of different funds. I'm not going to get into funds on this call today. That is really where you sit down with Eoin and Sean to get that diversity. But diversification, folks, is about having lots of different things in your portfolio, not just having lots of things. So I'll just finish on these final considerations. I believe volatility will continue into 2025 as tariffs, interest rates, and inflation battle it out. But typically volatility over the longer term is irrelevant. It may be relevant in the short term. It's part of investing. Remember, if you didn't have volatility, well, then why would you be compensated by the additional return? Additional return comes from the compensation for taking risk. Risk means different things to different people. Have a clear understanding of your objectives. Try not to let the short-term noise of the markets disrupt the long-term investment plan. Remember the power of compounding. I think if you remembered nothing else from my 20 minutes, it's investing is about time in and not timing the market. Be diversified. Lots of different things is different to lots of things. And a lot of the time we forget about that. Consider your investments in terms of assets and not in the context of funds. Any fund you invest in is made up of assets, and it's those assets that really matter in helping you achieve your objectives long term. Review your objectives, know your risk tolerance, and ensure you've got time on your side. Time is vital, particularly in a volatile market. And I think my final message would be, don't pay a high price for short-term emotional comfort. So Sean, Eoin, that is me finished, and I'm happy to take any questions if there are any.
Thank you very much, Andy, for that excellent and informative presentation. We've had a number of questions in. I'll start one with you, for you, Andy. Came in, the question was, Andy, Eoin mentioned gold as an asset, and what do you think of that for a pension investor?
Yeah, it's a great question. It's been asked a lot at the moment. I mean, gold has had a fantastic run, 15% year to date. It does, I suppose, offer some level of protection in a portfolio in the event of equity markets selling off. People see gold as a store of wealth, and all of that. The one thing I would say, Sean, to that is, I think it's back to that point of diversification. Would I like to have a little bit of gold maybe in my portfolio somewhere? Yeah, absolutely. I think it's a satellite holding in a portfolio. It's a 5, 7, 10% holding in a portfolio. Should it be 50% of a portfolio? I don't firmly believe so. The one point I will say about gold is this: what does gold produce for you? I personally like to invest in assets that are making me something. Companies are making something. They're producing profits. They're growing their profits. They're sharing that profit through dividend. I like that because I believe that's what generates long-term wealth. Properties typically go up in value over time, not always typically do. They pay a rent. I can see the rent coming in. So I'm inclined to like real assets in a portfolio, but gold then just acts as a diversifier and maybe as a bit of a store of wealth over time. So it's having a little bit of a lot of things, and I think that's how I would answer that question in relation to gold, Sean.
Thanks, Andy. So one for you, Eoin. What is the latest stage you can convert from a master trust to a PRSA and/or an ARF?
Okay, so the normal retirement age for a master trust arrangement is age 60 to 70. So 70 would be the oldest age. That would answer the question in short. But just to tease it out a tiny bit more, so at age 70, you could leave it sit in the master trust. You could take your retirement lump sum at age 70, the balance go to ARF. So that ARF is creating taxable income. If you wanted to postpone taxable income for another couple of years, you could come out of the master trust, go to a PRSA, because the normal retirement on a PRSA is up to age 75. So that would buy you another 5 years where you don't have to touch any taxable pot of income.
Thanks. And send Andy over to you. It's what happens if you actually plan to retire in a few months and the market takes a dip?
Okay, that's a great question. There's loads of answers, that I'm going to give you a very quick one if I can, but I think it's one that can be expanded out. I think go back to the point of time is vital. What is my time frame for any investment? And I believe when I've invested money, it is consequence versus probability. We spend a lot of time trying to work out the probabilities of where the market's going to go. I think what's much more important is what are the consequences of where the market goes. And if I've got a very short time period to my retirement, the consequences of a big dip start to become a little bit more important. If you're looking to go down the route of an annuity, the amount of money you have on the day you retire pretty much determines the level of income you're going to have for the rest of your life, because you're going in with a particular pot of money to buy that annuity. If that's the case, as you're approaching retirement, you should be de-risking your portfolio and going to safe assets in order to avoid that last minute dip. If you're going down the route of tax-free cash, where you're taking as much of the pot as you can in tax-free cash, similarly, because on the day you retire, what's there is the amount of money you have. You might not have time on your side for it to recover. If you're going down the route of an ARF, which is where most people do, remember what you're going to be doing is you're going to be retiring, but you're going to be reinvesting that money straight away. So actually the value of the pot on the day you retire isn't as important if you're going down the route of an ARF, because you will be reinvesting that money and you do have time for it to recover. However, very briefly, behaviorally, it can make a big impact to us, because none of us like to think we've reached the end of journey one, which is all of our years of saving, we typically don't want to see a 20 or 25% dip in the month in which you are retiring. So even behaviorally, if you're coming close to retirement and you're nervous about the markets, that could be the time to then take a more conservative approach with your money until you retire in 12 months' time. And then you can make your decision as to how you want to invest for the next part of your journey, which is what I call journey two. But I think you know, Sean, and Eoin is the same. That it's a great question, but it's a question that really requires the client to sit down with the likes of yourself and tease out all of those options, because there isn't any single right answer to it.
Okay, thank you very much. Now, the webinar is at an end, so I want to thank you, Andy and Eoin, but most importantly, you, the audience who have listened in today.